And I'm Atilla Yesilada. Today's topic is the oncoming global financial crises. This channel is about Turkey. Very rarely do I make exceptions. This is one of them. I don't believe in scaring my audience or giving them false good news, but as someone who has done his doctorate on Minsky and the financial instability hypothesis, i.e., the financial crises, their past, present, and future, I am extremely frightened that Trump's plans will lead to a global financial crisis, which could be as damaging to the world economy as the one we have experienced in 2007 2008, the great financial crisis. And no, I'm not going to talk about the trade wars. They are going to end very badly. They are going to hurt not only the American consumer and producers, but have spillover effects above and beyond China and EU, two countries which I think will not, for different reasons, negotiate with Trump to lower their tariffs. I'm going to talk about the American budget deficit and the notorious Mar-a-Lago plan. This video, as the rest of my videos, are pretty complicated. It's a master's level content. First, I want to provide some context about the importance of preserving the value of the dollar because it's the global trading and financial currency, and the role of the American Treasury bond market in terms of pricing all the credit issued in this world. Okay? Then I'm going to talk about America's budget deficit problem and how the current budget that's being negotiated in the Congress and at some point with the White House will exacerbate that problem. Three, I'm going to talk about the Mar-a-Lago plan, which, as far as I know, is still in progress, and how it could completely undermine the safe haven status of the American dollar and American Treasury bonds. Then I'm going to briefly describe the spillover effects to the rest of the world and how it could cause a financial crisis. Okay, start with the context. The world revolves around the dollar, okay? Even though a lot of countries hold fewer dollars in reserves and have replaced those either with euros or gold, it remains the main reserve currency. It's also the main trading and financial settlement currency. That is, if, say, I don't know, Malaysia and Turkey have a trade transaction, that's usually settled in dollars, not in their own currencies or in yuan, etc. So having a strong dollar or a dollar that fluctuates in a foreseeable band with low volatility is very important for the world economy. It is even more important for the world financial markets because all the other currencies are assessed against the value of the dollar. In fact, one of the most commonly used concepts in financial economics is the dollar index, measuring the value, trade weighted value of the dollar against six major currencies. And the way it goes up and down affects all of the other currencies and the ability of monetary authority in any country to conduct monetary policy. To give an example, Turkey has a very high inflation rate. To fight that, among other things, Turkey is pursuing what we call a strong Turkish lira policy, which means controlling the rate of depreciation of the Turkish lira against the dollar. Now, obviously, if the dollar rises by 10%, that job becomes more difficult and it may require interest rate hikes, even though the current economic conditions in the country would demand exactly the opposite. Because if you don't, then you have not enough dollars coming in. and eventually you will have a currency or balance of payments crisis. I think a lot of people are familiar with this discourse, but how the Fed interest rates, the American repo market or overnight market, money market, and the Treasury bills and bonds play a key role in the world financial economy. Essentially, every credit issued, every bond issued in this world is priced off the American interest rates. Let's say Turkey wants to borrow, the Treasury wants to borrow 10-year maturity, $2 billion in euros. First, the equivalent yield in 10-year American bonds are measured. On top of that, a euro conversion premium is added. On top of that, Turkey's risk premium is added. To give an example, if American 10-year bond yield rises from 4 to 5%, even though Turkey's economic conditions or risk premium had not changed, then the interest rate that Turkish sovereign has to pay on its own 10-year euro bond yield must increase at least by 100 basis points, probably more, but that's just me trying to prove that I'm an expert on this issue. Uh, so I'm not going to delve on that aspect. So in a sense, the American financial system, because of depth and the free market rules and independent monetary authority, are the safe haven of the world. That's where you go when you're afraid of risk. That's where you go to borrow if you have the credit rating. If the volatility of the dollar and the bond yield increases, then it becomes much more difficult to price financial transactions. If this volatility is too high or people lose their trust in the Fed or that the American Treasury will always honor its obligations in terms of paying off maturing debt, then the credit market freezes. It's called a credit crunch. In other words, nobody wants to lend Turkey for 10 years or even for 1 year simply because they have no idea what the value of the dollar and the 1 year American interest rate will be. So this is a huge problem. How does that relate to my biggest fear that that the world will experience a financial crisis? As I've said, it's not the trade wars. Even though the trade wars do have financial spillover effects, it's mostly something that affects the real economy. In general, if you raise tariffs, then inflation goes up by some measure and economic growth suffers by some measure. That's not only a theory or an axiom, but is well tested. A lot of people will tell you that the Great Depression was caused by the Smoot-Hawley Act, which raised American uh, tariffs on other world, the one on the imports from the rest of the world. It's more complicated than that, but essentially what we call the bugger thy neighbor policies, produce, which is trying to defend or protect your domestic industries by raising import barriers against the competition, is a very bad idea. It's been tested and proven true for over a century now. But that doesn't necessarily lead to a financial crisis. Yeah, some countries suffer a lot. They run out of dollars or euros. They have default problems, but it's not global. It's very difficult to imagine that, say, Turkey's default or Argentina's default would lead to a global financial panic. Which brings us to the true causes of the oncoming or upcoming global financial crisis. First, like all major developed economies, America has a budget deficit problem. Currently, the budget deficit, depending on which measure you use, runs about 6% of GDP. Trump's new budget plan, which is going to be adopted probably in 1 month or so, entails the continuation of expiring tax cuts as well as additional tax cuts. Independent authorities, not only Congressional Budget Office, but probably the ultimate expert on these, Peterson Institute, as well as others, have calculated that the way it's debated in the Congress, the new budget will raise deficits up to $500 billion a year and may add to America's $36 trillion worth of debt stock, $7 to $8 trillion in the next 10 months. Now, Dodge, run by Elon Musk, and Trump White House officials claim they're going to compensate for this effect by cutting non-discretionary, non-deficit, non-military budget expenditures. They don't exist. Only 25% of the American budget is discretionary and fits those two descriptions. And the most important of those are Medicaid and Medicare and other social programs. You can cut them somewhat, maybe a couple of tens of $1 billion, but you can't cut them to cover for the huge budget deficit that this budget will generate simply because of political reasons. Whether a congresswoman is Republican or Democrat, she has a constituency which has a rising older generation and poor people, and they certainly not vote for that person if she votes for a budget that will cut the Medicare or other social programs or health. So what will happen is that this budget will pass. Everybody will vote for the tax reductions, rebates, exceptions. Great. And that's going to saddle United States with additional budget deficits of up to $500 billion. All things being constant, that should raise the yield on the bond market simply because there is more issues and not enough buyers. China, for political reasons, and other countries, because of largely financial reasons, are not buyers of American debt anymore. So just the budget by itself could raise the bond yield, the 10-year bond yield, from currently 4.3% to above 5%. That's going to create a shockwave that reverberates through the global credit market. Every country will have to pay more when they issue bonds. And you have to remember, the current business model of any country or company is based on rolling over maturing debt and only covering interest expenditures from the company's revenues. That's generally accepted practice. No one plans, except in special circumstances, to pay off maturing debt. They have become an integral part of the balance sheet management or the financial management of every treasury and every company in the world. So, bond yields rising secularly, that means not for a few months, but as a trend, imposes a huge burden on other countries and companies in terms of paying off these bonds and raising new money. That also applies to the junk bond or other high-risk bond and credit instruments in the United States. So that's one shock. And this is why Trump and White House administration will never, never give up on the idea of tariffs, because the only way you can produce some revenue to lower the budget deficits I've explained in the foregoing section is to generate money through the customs. They will never compensate for the expansionary effects of the current budget, but they will, kick the can down the road, or they would have less of a negative impact on American bond yields. So that by itself is a problem. This is my humble estimate. I'm sure others will disagree. But to me, the American bond yield settling above 5% is a huge problem for the world. It will probably shut off half the world population from global credit markets. Now, these budget deficits have also a growth inducing effect. The government spends more, people spend it, what comes around goes around, the economy grows. So they are going to mitigate to some extent the recessionary impact of higher tariffs. But the problem is they too are inflationary. So tariffs are inflationary, the budget deficits are inflationary. This is why Fed can't cut or raise rates for at least 6 months until all the dominoes fall. Because acting too rashly based on the labor market to cut interest rates could stimulate inflation further, just like what happened after the COVID-19 crisis, and force Fed to take even more drastic action down the road. That's to raise interest rates very sharply and kick the economy into a recession. Neither can they increase interest rates now, simply because American economy, by all measures, is slowing down, such as the GDP and the PMI figures, etc. So really, they don't really know how the net impact of these all radical and very rapid changes is going to play out on the inflation and labor, employment items. That means Fed rates will remain high for the foreseeable future and will push bond yields further upwards. These are part of the global business cycle. By themselves, they're not going to lead to a global financial crisis. I think in the next 10 years, the world will have to deal with its growing debt problem and the fact that interest rates will never return to zero as they had after the 2007-2008 global financial crisis. But that's another topic. In the short run, what really could kill the global financial system is the Mar-a-Lago plan. The Mar-a-Lago plan has two pillars. The first is coordinated intervention by all major central banks to lower the value of the dollar. Trump, as our beloved President Erdogan believes, that a cheap currency will stimulate exports and reduce imports. Yeah, it does. There's no doubt about it. But the impact is minimal, okay? A country's trade deficit is determined by its productivity, by the value of its currency, but most importantly, by the disposable income growth differences between the trading partners. So as long as the United States economy is stronger than the rest of the world, then, there will be trade deficits. Of course, depreciating the value of the dollar has been tried in the past, the infamous 1985 Plaza Accord, but there's compelling evidence that the subsequent depreciation of the dollar has more to do with Fed adopting a looser monetary policy than coordinated intervention. In other words, when there are so many players, thousands, with huge balance sheets that can game against the central banks, depreciating the currency is probably not very possible. The second pillar is to exchange the bonds, American bonds, held by other central banks with 100-year maturity bonds which are not marketable and which are priced at a cheaper interest rate than the market. This would, of course, reduce the domestic debt and eliminate the debt ceiling problem. Sounds ingenious, right? Yes? No, no. Who would buy these? I mean, who would buy 100-year dollar bonds which they can't trade at a time when the same administration is also trying to depreciate the value of the dollar? That's simply telling other central banks, yeah, you're going to make some losses, but what the hell, you know? That's the price of doing business with the United States. Okay? Now, central banks and, five or six, let's say G6, could be browbeaten into accepting that. But the problem is, nowadays, most of these financial assets in target, that is bonds, are held not even in commercial banks, but by huge hedge funds or, bond funds. And they're certainly not going to play this game. Once United States renegotiates or reneges on its promise to pay off every sovereign debt to the penny, then the safe haven status of American bonds disappear. This is the fear now. This is the escape United States, America trade. People are looking for other safe havens. This is why you have this financial bubble in gold. I'm sure it's going to spread to other markets eventually, etc., etc. Now, you may think Trump is not serious about that, but I think Trump's policy path, what he believes, what he intends to do, will not change until the midterm elections. If in the midterm elections the MAGA crowd or Republicans lose at least one chamber of the Congress, then the Congress will have veto power on Trump's policies. But at this point, there is such a Trump wave, though it's declining in force, that the Senate and congressional Republicans are very loath to stand up to Trump. So essentially, unless someone changes his mind, uh, he's going to do these things. The problem is, he may change his mind eventually. His advisors may tell him that it's impossible to depreciate the value of the dollar, and, you know, not paying off American debt is going to be a huge shock to America and the world, but particular to America because most of you Americans have 401k or retirement accounts which hold large number of bonds. And if they don't pay off, well, then you don't get your extra retirement check, pension check. Trump will do those things. He doesn't even have to actually legislate or reach an agreement on the Mar-a-Lago plan. The fact that it comes to the fore of the policy front, right now it is not. And for instance, G6 is asked to meet in Mar-a-Lago to discuss the plan is going to create a huge shockwave. This will freeze the credit markets. No one will be able to issue bonds. Banks will not make overseas loans and probably will scramble to collect maturing loans instead of extending them, which is the usual practice. And this is as bad as the 2007 crisis. Imagine a world where the huge machine of lending and borrowing and rolling over maturing debt and doing all of these in dollars, or at least 65% of these in dollars, freezes suddenly. This is what we call loosely as a Minsky moment, where people realize that the dollar and the American bonds are a Ponzi scheme. You're not going to get your money back, or you're going to get much less than you have bargained for. And that's going to cause huge shockwaves. America will not be at the epicenter of this crisis. because even though borrowing costs for the American Treasury may rise as a result of these silly efforts, United States can still borrow. But other countries cannot borrow under these conditions. As I've said, even bond yields, American 10-year bond yields, rising to 5% or above is an unmitigated disaster for the poor world. Now, according to some projections, if the Mar-a-Lago plan is put in effect, the 10-year bond yield could rise to 6 or 7%. That is, from the current levels, roughly a 200 basis point increase in everybody's borrowing costs. Now, banks and the funds that buy these bonds, Turkey's bonds or South African bonds, are not stupid. They know very well the credit worthiness of their borrowers. A country that can easily service its debt at a dollar rate of, say, 6% may not be able to do so at 8%. Or if there is something called the spread widening, that is, the entire world becoming riskier because of the Mar-a-Lago plan, then they will have to pay 200 basis to 300 basis points above the current levels, which would put the credit rating of dozens of nations in jeopardy. We will see global credit downgrades. We will see credit default swap premiums rise, and most of the um, currency and interest rate swaps freezing. The credit market is unfortunately as important as the real economy. You could have a growing world economy, but if it's not financed, nurtured by the daily flow of credit, then the world enters a recession. This is what I call about. This is what I'm afraid of. Not that Trump will eventually put the Mar-a-Lago plan in effect. No other country is crazy to subscribe to that. But the fact, like he did with Powell, that he might publicly entertain the notion that he wants to exchange American bonds or depreciate the American currency is going to be enough to create a worldwide panic attack. That's like an infection. It may not affect Turkey or South Africa, what happens in the United States directly, but we're herd animals, in particular traders. And if someone panics, then everyone panics, then the entire herd starts a rampage. This is what's going to happen. I can't tell you the timing. I, I think as you watch this video, the Fed will have announced its May FOMC decision. Rates will not change, and FOMC will tell very clearly that it has no idea when it will be able to cut rates, or even if it will be able to cut rates for the next 6 months or so. That's going to be the first shockwave. The second shockwave is going to be American budget being signed into law by the president, which foresees huge budget deficit increases, but very vague plans about how to finance these. And of course, the trade war with China and potentially with Japan and EU, which will sell the bond holdings in their central bank reserves. I think as of the summer months, we will see the first tremors of a global financial crisis. And, if the gods in the pantheon don't change Trump's views and he publicly denounces the Mar-a-Lago plan or finds realistic, acceptable deficit cuts, the world is set for a very tough period. Thank you very much. Another complicated and probably convoluted presentation by me, but you seem to be getting used to it because my tiny audience is growing. I love your comments and your trolling of me. Please keep them coming. And if you like it, please subscribe and push the button. I don't know what the button pushing does, but it's something apparently you are supposed to do. Thank you very much for watching another broadcast by Real Turkey channel. This is Atilla Yesilada saying goodbye from sunny Istanbul.